Brad Williams. Frugal Finance, the difference between forward rate agreements and futures. As a hedging vehicle, FRAs are similar to short-term interest rate futures. There are, however, a couple of distinctions that set them apart. FRAs are not traded on an organized exchange, but are over-the-counter instruments. What does that mean? That means you can have brokers selling FRAs over the counter. Bank of America, Goldman Sachs, Citibank, Wells Fargo, etc., etc., etc. Although FRAs, and they're not organized. In other words, with futures, there's protection. There's always this counterparty problem with forward rate agreements and derivatives. That is the risk with forward rate agreements. Whereas with futures, it's standardized. There's no wiggle room in terms of contract size. A couple things. FRAs are private. Futures, there's always a paper trail. Forward rate agreements, not so much so. Although FRAs have fairly standardized contract provisions, they are not fully standardized the way future contracts are. When entering into an FRA, both parties to the contract entail credit risk exposure because they face each other directly. Futures, on the other hand, do not bear credit risk exposure because they are transacted through an exchange where each counterparty is facing the exchange. FRAs have the advantage that they can be traded for any maturity date. Futures, which are traded on exchanges, only mature on specific dates each year. The buyer of an FRA benefits from rising interest rates, whereas the buyer of a futures contract benefits from falling interest rates. Think through that one for a while. This is due to the fact that both contracts have different underlyings. While an FRA underlying is an interest rate, the underlying for a futures contract is an interest rate instrument. And an interest rate instrument increases in value when interest rates fall. This is summarized in the table below. In the previous example, I was going long, short, short, long. I forgot about this requirement here. I would probably reverse, and that's part of it. If you don't do this on a daily basis, well, sometimes you forget some of the critical criteria. Let's look over here. Let's look at the scenario. Party, FRA, interest rates fall. The buyer loses, future gains. Seller gains, future lose. Interest rate rise, FRA gains, the buyer. The future, the buyer loses. Seller loses with interest rates rising. Seller gains with futures. Oh, my head's spinning. All right. So in a nutshell, if interest rates go down, FRA buyers, they don't do as well. An FRA seller does better. Future buyer does better. Future seller, not so. If interest rates go up, FRA buyers does better. FRA seller, not so. Future buyers, not as well, but future sellers, they do better. Now think about this for a second. If interest rates go up, forward rate agreement buyer doesn't do as well. What happens with interest rates? Interest rates go up, prices go down. If prices go down, FRA buyers are short interest rates, I believe, and long price. If interest rates drop, they're short the position. Let's double check this. Okay, here we go. This is from section 2. Think through this one. So the buyer-borrower of a forward rate agreement is short price. Okay, I was backwards. And long interest rates. Think about this for a second. If interest rates go down, what happens to price? Price goes up. In a forward rate agreement, short price, you're betting that interest rates are going to go lower. Prices are going to go higher. FRA buyer doesn't do as well if rates go down. If rates go down, rates drop, price goes up, and they're short price. That's not good. If interest rates go up, FRA buyers does better. Think about it for a second. Interest rates move higher. What happens to price? Prices drop, and you're short price. That's good. Interest rates move down, go back over this again. Interest rates go down, prices go up, and you're short price. Yeeks. Not good. This is where you may end up having to settle with the lender. Think through this one for a second. If interest rates go down, the FRA seller does better. So again, interest rates go down, prices do what? They go higher. Lower interest rates, higher prices. The lender is long price. Interest rates drop, price is going to go higher. Think of the futures market. If interest rates go down, the future buyer does better. So that means future buyers are going to be short the rate and they're going to be long the price. See how that works? Think about it. Future buyers are going to be inverse to FRA buyers. If interest rates go down, they're going to be long price and short interest rates. Higher price, lower interest. Future price does better if interest rates go down. If that's the case, they're going to be short interest rates, long price. If they're short interest rates and interest rates go down, price is going to go higher. They're bullish on price and bearish on rates. This is what you have to think through when you're doing this. It has to be in milliseconds. It's not something you even think about. It's something that it's just so ingrained that you just know it. You have 10 years of experience. You've been doing these trades forever. You don't even think about it. As a newbie, and because I don't do this on a day-to-day basis, I have to think through this. So that's why I'm just verbally trying to point out why when you're long, when you're bullish, and when you're bearish, that you're going to see different positions between prices and interest rates. Stop for a minute, think about it, write it out if you need to. Practice. Brad Williams, Frugal Finance. Hope that helped.